Analyst Lisa Ellis is here at Post 9 to talk about how it's impacting some of the credit names we follow. These numbers are always hard to put into context when they come out because they're so large. What do you say about this one?
Yeah, look, so for the first time in 3 years now, credit card balances are back above where they were pre-pandemic. But the important number is that as a measure of financial stress, meaning the amount of any individual's income that they're spending to service their debt, we're still well below pre-pandemic levels because incomes have gone up as well.
Right. So is a return to trend on that ratio dangerous at this point?
Yeah, it's coming. I mean, we're still below. It's about 14.5% currently. That's the amount of any individual's income going to service debt. The pre-pandemic average is, about 15, and we're trending back toward it. And given the rise in rates and obviously inflation, we're monitoring that really closely.
You cover American Express, and there's been some talk that that's the way to maybe have it both ways, where you have the higher incomes, more spending volumes, lots of travel come back, and yet maybe less risk of credit loss down the road. Does it make sense at this point?
Absolutely. Amex is one of our favorite names. It's actually been one of the best performing stocks in our coverage in the last 2 years. They took advantage of the pandemic to really embrace that affluent consumer base. So their charge-off levels are still hovering only around 1%. And they've already guided that in 2023, they expect them to stay well below where they were pre-pandemic. And you're seeing still all the recovery in travel. Their volumes were up 15% this last quarter. Visa and MasterCard's only up about 8 or 9%.
And then what do you look at if you're looking at the Visas and MasterCards in terms of overall transaction activity? So is it, migration from more debit volume to credit, or as a macro signal at this point, what's relevant?
Yeah, so with them, it's the overall number that really matters because they are such a diverse view into the health of consumer spending. Almost 50%, and in the U.S. it's almost 70% of consumer spending is done on a card. So by watching their volumes, which are both debit and credit, you can see that overall health in real time. And so far, it's extraordinarily healthy. The consumer, while they still have jobs, they're still spending.
And then,
Lisa, I'd just love to come back to some news earlier in the week because it is a name you cover, not related to this. FIS, guidance was just horrific, stock down, but they also announced the possibility of a very large transaction, so to speak, in the spin of what is WorldPay. Any new take for us? Stocks come back a tiny bit since, I guess, that significant down day early in the week.
So this is one that's been in a very rough road over the last 6 months. Our outlook for 2023 for FIS is down 35% from where it was only 6 months ago. They are really suffering at the hands of like a Square, a Clover, a Toast. Those players, they don't have a product like that, and it's crept up on that business over the last couple of years. And the problem is, as they're losing share in that market, it's very high margin volume. So you've seen this sort of cascade effect that their revenues are decelerating and then their profits are falling off more dramatically. So they have a new CEO, a new CFO, several new members of the board. Jana, the activist, is somewhat involved, not heavily, and they've decided to spin off their troubled unit. It's the big payments unit.